Hello all. Today we are going to discuss about capital gain. What is capital gain? So any gain arising out of transfer of capital asset in the previous year is called as capital gain. So what do you mean by gain arising from capital asset? So the meaning of capital asset is any property of any kind which is being held by an assessee which is not connected with the business. It can be a property of movable or immovable, tangible or intangible, or fixed or floating. So that is called as capital assets. So if you are getting any gain from that capital asset, then it is called as capital gain. So there are some conditions which we need to follow to compute a tax on the capital gain. The first one, there should be a capital asset. That is very, very important. And it must be transferred by an assessee. And the transfer should be taken place in the previous year. And any transfer you have done or any gain on such transfer should not be exempted from the various sections called 54, 54B, 54D, 54EC, etc. Then in those scenario, any gain what you get is taxable as per income tax. What are the item not considered as capital asset is stock in trade, raw material, any consumable goods held by an assessee for the purpose of business, and any movable assets which is being used by an assessee for personal purpose. Say, for example, I am using a car. Okay, that is car which is being used for personal purpose. In that case, that should not be considered. But except jewelry, which is in the form of gold and silver, any gold deposits, bonds, etc. What do you mean by transfer? So in the previous slide, we saw any transfer of capital asset. So we know what is capital asset. Now, what do you mean by transfer? So a transfer as per section 2, subsection 47, it is any exchange or any sale or any relinquishment of assets or compulsory acquisition under the law. Okay, so any of these process which is being taken place for for moving the property from one person to another, then that is called as transfer. What are the item you will not consider as a transfer is any assets, transfer of assets in the nature of amalgamation you have done, debenture of bonds, any assets in a kind at the time of liquidation, assets by gift or will, etc. are not, it's not a transaction as transfer. Now, when you compute capital asset, we need to know whether it is a short or long. So this pictorial representation will help you out to know what kind of tax, because based on this only a tax will be levied. Okay, we are going to compute based on this concept. So you should be clear with what is capital asset and what is short term and long term. So here the capital assets are classified into short term and long term. So short term, again, it is grouped into two categories. One is financial asset, another one is other than financial asset. Likewise, even the long term, financial, other than financial. So what do you mean by short term? It is in a short period of time. Long term, let it be 1 year. In case of financial asset like that, there is a condition. So what is financial asset? Any stock, shares, etc. are considered as financial. Other than that, the rest of the assets like land, building, all these comes under the category called other financial asset. Now, if a person is holding a financial asset which is less than 1 year or less than 12 months, then it is considered a short-term financial asset. At the same time, if the asset is being holded for more than 3 years or 36 months, then other than financial asset, then it is considered as less than, if you are holding, it is short term. Likewise, if a financial asset, that is shares or stocks, anything which we hold more than 12 months, it becomes long term. Any land and buildings which you are holding or any other property which you are holding more than 3 years or 36 months, then automatically that becomes a long-term asset. This is a format for computing the long-term capital asset. So you need a sale is being done. So sale consideration, detect all your selling cost, which means brokerage, anything incurred for making a sale, you can deduct that. And then indexed cost of acquisition you need. Since it is a long term, we use indexed cost of acquisition and less indexed cost of improvement. From after deducting that, what you get is your long-term capital gain. So you need, this is the inflation index, because using this inflation index only, we will compute the indexation. Yes. So what do you mean by cost of acquisition? So cost of acquisition means a cost incurred for getting that property, for acquiring that asset, is called as cost of acquisition. In case there are self-generated assets, the cost of acquisition is nil. It means what? If the company is created, if there is a goodwill, that is a self-generated asset. Goodwill is a self-generated. So there is no cost of acquisition for that. And suppose a property is transferred from my father to me. Okay, so here I am not acquired, I have not purchased that property. So when I'm selling any property, that property, the cost acquired by my father, that cost will be taken as a cost of acquisition. Next, cost of improvement. Cost of improvement means any improvement which you are doing on that property is called as cost of improvement. It's simple, repairs, renovations, etc. Now we saw for computation indexed cost of acquisition. So indexed cost means you are using an inflation index, because 20 years before you got the property for 75,000. The same property does not cost 75,000 now. It might be going in crores, right? So you are converting that cost into inflation index as per the inflation index, okay, the present value. So that is what you call it as indexed cost of acquisition. The next is indexed cost of improvement. So any improvement which you have done, if you are computing for long-term capital gain, then you use indexed cost of improvement. You know the meaning, what is improvement? It is any improvement which you done on the property, right? So here, any improvement, if you have made before 1/4/2001, that should not be taken into calculation. So any improvement on the property which you have done after 1/4/2001 can be considered for the calculation of computing capital asset. Hope this video is useful for you. Thank you. Thank you for watching. Have a great day.